Welcome back to Elite Money, where we break down the real story behind gold, silver, and global markets. Silver has just crashed hard. It is down 22% from its record high and dropped 17% in the last 24 hours alone. Around $1.1 trillion in value has been wiped out. Right now, silver is trading near $95 on COMEX. Gold has also fallen back below $5,000. What makes this moment so important is how closely price is following the technical levels we discussed earlier. Silver bounced about 10% at first, but then selling pressure broke a key moving average. Once that level broke, the path opened toward the 90 to 95 support zone. That is exactly where we are now. The market is testing whether this support holds or whether silver falls further toward 86. But here's where things get shocking. While silver trades at $95 on COMEX in New York, it is trading near $136 in Shanghai. That means the premium in Shanghai is about $36. This is the largest premium ever seen. Physical silver in China is trading roughly 37% higher than paper silver in the US. Think about that. The same metal has two very different prices. The physical market is saying silver is much more valuable than the paper market suggests. At the same time, silver is moving with extreme volatility, almost like crypto. It dropped $20 in a very short time. Gold lost trillions in value in just one day. This is not normal trading. This is forced selling. It is the paper market breaking under heavy leverage, while the physical market is sending the opposite message. Now look at the ratios. The gold to silver price ratio is about 51 to 1. That means gold is priced at 51 times the price of silver. But in mining, for every 1 ounce of gold produced, about 8 ounces of silver are mined. In COMEX vaults, the ratio is about 1 to 12. In LBMA inventories, it is about 1 to 3, so silver is mined much more than gold, stored more than gold, yet priced far lower than gold. Does that make sense? And here is the key point. Silver inventories are falling. Vaults are being drained while the price ratio keeps widening. That contradiction is important. Now let's talk about what triggered this crash. The timing is suspicious. Gold and silver started falling during the opening of trading in China. Then the London Metal Exchange announced technical problems and delayed its opening. Right as that happened, silver dropped sharply from around 115 to 95. There was no major fundamental news to justify such a massive crash. The main thing markets are watching today is Trump's expected pick for the next Fed chair. That announcement could change everything. If Trump chooses a conventional Fed chair, markets might stabilize or continue falling. But if he surprises everyone and chooses Judy Shelton, gold and silver could rebound sharply, and it could mark a major shift in monetary policy. Judy Shelton is an economist and a strong supporter of sound money. She has argued for linking money to real assets like gold. She has also proposed gold-backed bonds as a way to move gradually toward a more stable monetary system. Under a gold-backed system, governments cannot print unlimited money. Inflation is more controlled. Debt cannot grow endlessly. People and businesses have more confidence in the value of money. When Trump nominated Shelton in 2020, her nomination faced strong opposition and was blocked by the Senate. Why? Because her ideas challenge the current system, where central banks can print trillions of dollars and support financial markets. Recently, Shelton suggested issuing bonds tied to gold instead of dollars. Investors could be paid back in gold, not just paper money. This would create a parallel system based on real value and could push governments toward more responsible spending. If Trump chooses Shelton today, it would signal a major shift away from unlimited money printing. For gold and silver, the impact could be huge. The paper market would face serious pressure. The system that has kept precious metals prices low for decades could be challenged directly. That is why today matters so much. That is why the crash happened at such a strange moment. And that is why the market reaction feels coordinated. But let's return to the technical picture. Yesterday we talked about key levels. Silver bounced from a major moving average, then broke below it. We said if that happens, the next target is the low 90s. That is exactly what happened. Now the market is testing the 90 to 95 zone. If it holds, we could move higher. If it breaks, 86 becomes the next target. Here's what makes this crash different from previous ones. In the past, when silver crashed, physical demand would weaken and premiums would fall. This time, the opposite is happening. Physical buyers in Asia are paying huge premiums. They are not scared, they are buying aggressively. Every time the paper price is pushed down, physical demand increases. Every ounce that is shorted on paper is absorbed by real buyers. The gap between paper and physical is widening. Of course, there are real risks. After a 22% crash, the technical damage is serious. If support breaks, silver could fall further. Traders using leverage have already been wiped out. Forced liquidations are driving volatility. And if Trump chooses a traditional Fed chair, the current system may continue for longer. Silver could be pushed lower before a true bottom forms. At the same time, crypto, stocks, and metals are all falling. If this is a broader risk-off move, precious metals could be dragged down in the short term. But none of that changes the bigger picture. A record Shanghai premium is not a sign of weak demand. It is a sign of intense demand. The gold-to-silver ratio is extremely stretched. Historically, when this happens, silver eventually outperforms gold in a powerful move. Vault inventories are falling. Physical demand is rising. The paper market and physical market are moving in opposite directions. That situation cannot last forever. Either paper prices rise to meet physical reality, or the credibility of the paper market collapses. So where does this leave us? We are at a critical point. Technical levels are being tested. The physical market is showing extreme stress. And a major policy decision could be announced today. If support holds, we could see a strong rebound. If it breaks, we may see another drop before the real move begins. Either way, the next move could be historic. Stay alert. Understand the risks. Avoid excessive leverage. If you understand what is happening structurally, this could be the kind of shakeout that happens before a major shift in the market. Thanks for watching Elite Money. Stay smart, stay focused, and see you in the next video.